Multiple reports said Chinese regulators told brokers to remove client-dedicated, ultra-low latency servers from exchange data centers tied to major Chinese bourses, moves that hit the Shanghai Futures Exchange ecosystem and the kind of high-frequency traders who live on microseconds. The official language? Limit speculation. The market heard something else. They hit the kill switch. So the real question isn't, did China ban HFT? The question is, why would you slow down a market that's already moving like it's running out of oxygen? Because when a squeeze starts, speed becomes a weapon. And when the weapon points back at the exchange, the easiest way to survive is to slow time. Let's walk through what this move actually does, why it's happening now, and what it could mean for silver going forward. What they actually removed: the speed advantage. High-frequency trading isn't magic. It's plumbing. The edge comes from proximity, servers sitting right next to the exchange's matching engine. The closer you are, the faster your order hits the book. A few milliseconds can mean you buy before the crowd, sell before the stampede, and scalp the spread thousands of times a day. When regulators force those servers out of exchange-run data centers, they don't delete HFT from existence. They remove the unfair inside-the-house advantage. Everyone gets slower, the market gets thicker, the spread gets wider, and most importantly, price discovery becomes less instantaneous. That's why I'm calling it a kill switch. Not because trading stops, but because the market's nervous system gets dulled. Why this matters specifically for silver. Silver is not just a metal, it's a pressure gauge. It sits at the intersection of investment panic and industrial demand. It trades like a small market, but it's used like a strategic material. That combination is explosive, because a small market can be pushed, and a strategic material can't be substituted overnight. Now add leverage. Silver futures are a place where a lot of paper silver can change hands without any metal moving. That's fine until the moment people start asking for delivery, or until the market fears a delivery problem, or until physical premiums start screaming that the paper price is lying. In that world, HFT doesn't just provide liquidity, it accelerates the move. It turns stress into a cascade. So if you're a regulator staring at a market that can gap up, trigger margin spirals, and create a social media-fueled frenzy, you don't just raise margins and pray. You cut the speed line. The timing. Why now? Why now is the heart of this story. If the market was calm, nobody would care about co-location servers. You care about speed only when speed is amplifying instability. There are three plausible motives that stack on top of each other. Motive A: stop the feedback loop. HFT thrives on feedback loops. Volatility creates opportunity. Opportunity attracts more speed increases churn increases volatility. It can look like liquidity, but in a stressed market, it becomes a blender. Removing co-location breaks that loop. It forces strategies to slow down or relocate. The machine stops chewing as fast. Motive B: protect retail, or protect the exchange from retail. China's markets have huge retail participation. If the tape goes vertical and then whipsaws, you don't just get losses, you get anger. And anger is a political risk. So the public story is fairness and protecting small investors. That might be true. But there's another angle. The exchange itself has a survival instinct. If a short squeeze runs too fast, the clearing system is the one that chokes. The exchange becomes the battlefield. Motive C: hide the true speed of the squeeze. This is the controversial one. Critics argue the government isn't trying to stop speculation. It's trying to control the narrative of the move. If silver is in a genuine squeeze, the worst thing you can do is let the tape reveal the squeeze's true acceleration. Because once the public sees this is not a normal rally, they pile in. And when they pile in, the squeeze becomes self-fulfilling. So what do? You blur the tape, you slow the heartbeat, you turn a sprint into a jog, long enough to manage risk behind the curtain. Are they blinding their own investors? Here's the uncomfortable question. If you remove speed traders, do you reduce chaos, or do you reduce transparency? HFT firms aren't saints, but they do one thing extremely well. They connect fragmented markets. They arbitrage tiny gaps, move quotes, and keep prices aligned, especially when everyone else is slow. When you kick them out, you can get wider spreads, meaning worse prices for everyone, thinner books, meaning bigger jumps on small orders, more slippage, meaning stops get hit harder, more gaps between venues, meaning the same metal can price differently in different places. So yes, in the short run, this can feel like the market is being blinded, not because information disappears, but because the fastest messengers are removed. And when the messengers disappear, rumors become louder than quotes. The kill switch theory. A controlled burn. Let's be blunt. If silver is entering a phase where physical demand is colliding with paper leverage, regulators have two choices. Choice 1, let it rip. Choice 2, slow it down. Slow it. A controlled burn is always preferable to a wildfire. You'd rather stretch the move out over weeks than let it explode in 2 sessions and then implode the clearinghouse. So this is what the kill switch could represent: a deliberate attempt to turn an uncontrolled squeeze into a managed repricing, not to stop silver, to stop the panic. What happens next? The consequences to watch. If this clampdown is real and sustained, watch for these fingerprints. Fingerprint 1, volume shifts. HFT volume doesn't vanish, it migrates. It goes to nearby data centers, alternative venues, or different products. Watch whether liquidity drains from specific silver contracts and reappears elsewhere. Fingerprint 2, more limit-style moves. Slower markets with thinner books can whip harder, not softer. Ironically, the attempt to reduce chaos can create bigger intraday gaps. Fingerprint 3, physical premiums matter more. If paper liquidity becomes choppier, physical markets start to lead. Premiums, delays, back orders, and regional price spreads become the truth. Fingerprint 4, policy stacking. This is key. Server removal rarely comes alone. If you see tighter position limits, new margin guidance, stricter intraday rules, or sudden risk control notices, that's the full clampdown playbook. The bigger story: silver is getting reclassified. Here's my thesis. Moves like this happen when an asset stops being treated like a toy. When regulators intervene at the microstructure level, servers, co-location, execution speed, it signals one thing. They believe the market's internal mechanics can cause systemic damage. That's not how you treat a minor commodity. That's how you treat a strategic choke point. And silver is a choke point. It's industrial, it's monetary, it's small, and when it runs like a rumor with a fuse. So if China really pulled the plug on high-speed access, don't interpret it as silver is over. Interpret it as the people running the casino didn't like how fast the table was catching fire. My checklist for viewers: no hype, just signals. Over the next few sessions, track SHFE, silver futures, open interest versus volume. Any exchange notices about risk controls or position limits, spreads and slippage. Do quotes get worse? Physical premium chatter. Do real-world prices diverge? Cross-market gaps. Does Shanghai move before New York more often? If the market is being slowed, the big moves don't disappear. They just arrive with more friction. And friction is how you hear a machine breaking. And one more thing. When speed is removed, the winners aren't the little guy. The winners are the players with inventory, relationships, and delivery pipelines. In markets, possession beats prediction. Final thought. A kill switch isn't pulled when everything is fine. It's pulled when someone behind the scenes sees a speed-driven event, something that could outrun control. So ask yourself, if the tape has to be slowed, what exactly were they afraid you would see? If you want, comment one word. Speed, if you think this is about fairness. Smoke, if you think this is about hiding a squeeze. And if you're watching silver in 2026, remember, the price is a headline. The plumbing is the story.